February the 22nd of 2022. Today's the 24th, and keep in mind some of the data, and I'll mention it as we get going through the program, is not available because February is a relatively short month. So normally we would have at least 4 or 5 more days to collect some information. I'll bring that up as we get through the program. So welcome everybody to the program today. At the conclusion of this morning's presentation, you'll have an opportunity to participate in a Q&A session after. And keep in mind, we're only going to record the presentation. So we're ready to get started. Okay, so today's agenda, we're going to talk about key economic indicators, the global economy, the domestic economy, mergers and acquisition, and other significant economic news. And today I'm going to address what's ahead in 2022. We're going to address today commercial and residential real estate market for 2022. So let's start with the commercial real estate market, just to give you some overviews at a high level. So the commercial real estate investment activity roared back in 2021, thanks to strong investment demand and abundant capital flows. Capital availability will continue to support a buoyant acquisition market as we move through 2022. More foreign capital is expected to target the U.S. assets in 2022 as international travel restrictions ease and cost to hedge against the dollar depreciation will remain very low. Total investment volume in 2022 is really projected to increase between 5 and 10% over the 2021 levels, which are on track to roughly equal pre-pandemic volumes from 2019. But basically, currently, this is the highest annual total on record recorded. And investment in offices and retail assets should also pick up. Industrial volumes are projected to increase between 10 and 15% over last year, while office and retail volumes will rise about 5 to 10%. Meanwhile, hotel volume for the first 3 quarters of 2021 recovered to pre-pandemic levels. So it's a positive sign for the sector in 2022. So in the office market area, the next normal U.S. office market activity strengthened in the second half of 2021. The momentum likely will continue in 2022. However, occupiers are still determining how best to support a hybrid workforce and how it will impact their portfolio strategy. So, demand will be greater in 2022. The office market will contend with the highest vacancy in nearly 3 decades. And that means of lower rent rates until the second half of the year. So keep in mind, a lot of companies are still deciding how they're going to go forward strategically with their current workforce. How many people will work at home or how many people will come back to the office. But I think we'll start seeing things coming back as we move further away, hopefully, from the pandemic. Keep in mind, throughout 2021, new lease transactions increased from pandemic lows, and we had negative net absorption diminished, and we saw sublease space began to recede among strong growth naturally. So a lot of companies had a lot of extra space, and you had small companies as well as startups that were basically getting involved in renting space from other companies that had an abundance. So the average asking price for rents will remain subdued in 2022, with a downturn primarily in markets underperforming the suburbs in the near term and bounding back in the long term. So the cities, the downtime you'll see in the cities, such as maybe Los Angeles, San Francisco, you'll see that continue until late in the year. So the predictions, if you will, for the office space, since the vaccine rollout, employees have begun returning to the office. While some continue to work remotely, a lot of people have gone back between 1, 2, and 3 days a week. And what we're seeing now is many say that employers will implement a mixed working model, which is going to be here indefinitely. And those who do return to the office will likely require more personal space. And thus we expect density populated open plants to be a thing of the past. Now, for those of you that are familiar with Hewlett Packard, when I used to visit them, they don't have offices. The whole thing is just open areas where everybody was sitting in little cubicles almost on top of each other. So that's going to have to be revisited to determine how they're going to work with that going forward. You're going to see the demand for more personal space may make business owners consider office relocations to larger but cheaper premises in the suburban areas. The life sciences area is growing continually. We're going to see that throughout 2020. This is fueled by the advancement in biotechnology and record levels of venture capital and other sources of funding. You know, the average rents are at record highs right now. For example, in the life sciences area, such as the clusters of Boston, Cambridge, San Francisco area, and San Diego, the rents are continuing to skyrocket because of demand. We all wonder about the retail, and basically the retail sector is recovering relatively well from the pandemic major disruptions. Existing retail space is more efficient, with sales per square foot improving due to the new stores being built and rising retail sales. So people are going back to stores now to go shopping. In addition to being online, you're seeing people going back into the stores to do the traditional buying. In addition, we see record levels of venture capital are targeting what we call retail focused companies. So the productivity area, what we've seen in the spaces since 2010 to 2020, retail sales have grown 42%, while the supply of new space has only increased 4%. So that's good news from that perspective. And consumer spending is forecast to rise in 2022, as you've seen a buildup from personal savings during the pandemic is being released. So the market to watch in 2022, well, basically the commercial real estate market will come back greater than it's been in a long time, but it'll be bright as we move further in the year. So it's some predictions basically is logistics real estate is in high demand, and we need more inventory storage in management facilities. So the bottom line is 2022 will be another good year, strong year in real estate and commercial business. And one of the things we've seen basically investments in multi-complexes, self-storage, and the industrial. Somebody has to turn off your
Dennis, excuse me, you need to unmute yourself, Dennis.
Sorry about that. So as we move forward, mortgage rates are possibly going to rise between 4 and 5 times this year. And that's going to start sometime in March. We'll see that within a couple of weeks. Prices should moderate, but low inventory will continue to be a problem. Home prices and construction had a banner year last year, and that'll continue. Even as interest rates rise, rates are historically lower than they have been in previous years. If you go back to the 80s, you saw interest rates running somewhere between 12 to 14 to 15%. So we're nowhere near that right now. And I don't think we'll hopefully ever see that again. Last year was a great year for selling your home, but not a great year if you were trying to buy one. Home prices rose sharply and the number of homes for sales declined. So in 2022, the housing market will still be tilting towards the sellers. It offers an opportunity and chances to snag a dream house going forward. Last year, you had a lot of people lining up. I mean, homes had 5 to 10 offers on a specific location. Prices went through the roof. In some cases, people paid over $100,000 more than the asking price. So we've seen that the typical home has sold in 15 days in 2021, and more than 60% were off the market within 2 weeks. So that was last year. We'll see what that means going forward when we see the interest rates. So the real estate market will change, and the warning signs are already up as low interest rates and mortgage rates are beginning to rise. So the real key is affordability will become a key factor, especially for first-time buyers. In December, information indicated that of the new homes that were sold, almost 30% were first-time buyers. And I think those numbers may change substantially going forward as interest rates rise and the affordability index becomes a major issue. Economists are expecting price appreciation for homes to go up about 6.6% this year. Many expect the second highest sales in the past 15 years to continue on, again, with limited inventory. So there are some key underlying assumptions that we really need to take a look at. So first of all, the first one is a pullback. Last year, one of the hottest and the most competitive housing markets in history, it was largely driven by record-setting low mortgage rates. The average during the year was somewhere around 2.65, and I'll address that later in my presentation. Secondly, the slowdown, what rates were, for example, refinancing was huge. It was a big market for that. And last year, we had $1.6 trillion in loans refinanced. That's astronomical. That's a jump of 33% over the prior year. As rates inch up, though, the incentive to refinance wanes, and even just a small increase in rates can significantly cut down on home buyer savings and make refinancing to be an issue for people to feel in that marketplace. So you're looking at the cost, fees, and other particular items that will impact somebody who's trying to either buy a new house from the one that they have now or try to get in for the first time. Secondly, we have the slower rate of price growth. Home prices have astronomically been incredibly high over the last several years. What we're seeing now is that those trends are largely behind us now. As we move into 2022, that market will change. So what does this mean for your real estate goals? Well, if you're hoping to make some type of real estate play this year, it's important to keep in mind the market is changing on a daily move going forward. For existing homeowners, it means that you need to pull the trigger sooner than later to refinance in the cards. So while rates continue to go up, you may need to look in terms of changing areas that you may want to live because of the rates it's going to cost to buy and the payments it will take on a monthly basis. But either way, planning ahead is going to be crucial. The market is moving fast, and you're going to have to move just as fast to stay up with it. So that kind of takes us through the market in the real estate area. Now let's take a look at the key economic indicators. So we want to look at gross domestic product, inflation, unemployment at the federal level, unemployment at the California level, and of course for Bill Holland, the price of oil per barrel. So the global economy is pegged right now to go out of 4.4% globally, and then dropping down to 3.7% in 2023. Looking at the United States, we're looking at 3.4% this year, and then possibly going down to 3% next year. The inflation factor is running a solid 5.2%. You know where we were. I think the implications will be what happens with the oil market, what happens with the supply chain, et cetera, will have a major impact on the inflation factor going through this year. Also, the unemployment rate we're looking at on a national level at 3.8% this year, and then going down to 3%. California's unemployment is again trails the national average at 5.1%. The figures for unemployment for 2023 have not been released. Now, when I put my slides together last Friday and Saturday, I had a range of oil from $57 to $100 a barrel. Right now, it's at $107 a barrel because of what's taking place in Europe. And so we'll have to keep that tuned in as we move further into March. So on a global basis, the Chinese economy finished 2021 on a steady note, though COVID, regulatory concerns, and real estate difficulties continue to weigh on their outlook. However, economists do believe we'll see a slower growth in China in 2022 compared to last year. In emerging currencies, were two key areas. Political risks have calmed down in Peru and in Chile. As a result, we forecast will be less weakness in their currencies than have been in the past. The United Kingdom economy is displacing increasing divergent trends. The CPI inflation has continued to trend higher, reaching 5.4% year over year in December, and it could peak as high as 6.5 to 7% sometime in the first quarter of this year. You know, while elevated inflation will clearly warrant the Bank of England tightening their standards of taking monetary policy, they're already taking action. They've already raised their basis points by 25 points, and you'll see more tighter economic policy going through the year. Australia is on the verge now. They're seeing a steady upturn with a rebound in activity and quickening of inflation in the first quarter. Economists believe that there'll be more solid economic growth will continue in 2022. And of course, the Reserve Bank of Australia has become modestly hawkish, as we are here. And basically, the Central Bank of Australia has stated they're going to stop quantitative easing, and that'll take place between now and sometime in March. This is similar to what the United States is going to do by quantitative easing here, by stop putting a lot of money into the economy. And of course, the Bank of England, the other thing I was mentioning earlier, they're going to raise basis points 2 or 3 times this year, and that is an attempt to get inflation down. They expect the high point to be around 7.2% through April of this year. Now let's take a look at the domestic economy. So first of all, the latest GDP showed that the U.S. economy grew at 6.9% annualized in the fourth quarter, which is incredible. And this is the strongest full year quarter we've seen since 1984. And the Omicron surge cases in December had a chilling effect on retail sales that month and contributed to widespread absenteeism in the workplace, as well as inventories beginning to stack up. And that should start reversing as we move further into the year. As I mentioned earlier, you can brace for more strong economic news from the Federal Reserve. The Federal Open Market Committee announced that it's crystal clear that they're going to be taking rate hikes imminently, probably in terms of March. It could go up 4 or 5 times this year. I'll talk a little bit about that later. Economists basically said that the first 25 basis points will take place on the meeting the week of March 16th, the meeting of May 4th, and then June 15th at the policy sessions. So we'll have to wait and see what takes place depending on how inflation is tracking and other events affecting our economy. The target range right now, as I said, it's for 125 basis points in 2022, and the target next year is another 75 basis points. So that's where we're looking at right now over the next 24 months. So the supply of homes plummeted. The U.S. inventory is at the lowest level in more than 2 decades, and we've got fierce competition from ownership. So the low level inventory levels, basically the seller owns today's marketplace. The seller is not in a hurry to sell. And basically you have a lot of people, we're in the winter time frame right now. So activity is kind of slow at this point. Perhaps as we move into March and April timeframe, we'll see that activity picking up because a lot of families want to make moves to new school systems, et cetera. So we'll see that happening. What's interesting is we're coming off the best sales year since 2006 when we had the housing bubble. And last year nationally, we had over 910,000 fewer homes on the lots for purchase since 1999. In today's environment, houses are being snapped up quickly, often within days, as I mentioned earlier, but the rise of interest rates will reduce purchasing power by the buyer. And what we're going to see here, it may force many people to sit on the sidelines and wait till things change in order to buy something. Again, we're talking about the affordability index. But we expect more inventory to come online during the year as the year unfolds, especially as we get to the summertime. The one thing that's crystal clear is inflation. I mentioned earlier that in January, inflation went down 7.5%. It's the highest rate in 40 years, going back to February of 1982, well above the market forecast, which is 7.3%. Energy costs soared. We had labor shortages. We had supply disruption, coupled with other high demand and weighing areas. So if you've gone into places like Target and other places lately, they still have a lot of empty shelves. There's still a lot of ships sitting offshore that need to be unloaded. So supply chain is still a critical issue, along with the oil supply. Energy, if you can imagine, is up 27% in the last month and a half. The product price index shot up too by 9.7% for the full year last year, which is very substantial. The trade numbers that I have for trade exports, they're not released yet. They won't be released until sometime into early March. And again, that's because of year end. The trade deficit for 2021 became a record high. The deficit increased 3% to $101 billion. I mentioned before that every month it was getting worse. Well, listen to this. The US trade deficit in goods topped $1 trillion in 2021. That's the highest ever rated, over $1 trillion. And that is very bad for the economy going forward. And that's got to change. Retail sales for the month shot up to 3.8% in January, which is more than double the expectations of economists. That's the largest gain we've seen in quite a while since we went out in March of 2021. Gains were really broadly based in various areas, such as food, auto dealerships, et cetera, especially in gasoline prices going through the ceiling. Now, if we take a look at the unemployment picture on a national level, payrolls increased by 467,000 in January. That was higher than expected. Now, the unemployment rate inched up to 4%. Why? 2 reasons. Number one, a lot of people had those temporary jobs for the Christmas holidays. Those jobs ended in sometime in January, a lot at the end of December and January timeframe. Also, people now are running out of their free checks from last year, and they're starting to go back and look for jobs. So they're applying for unemployment, get back in the marketplace. So we could see the unemployment rate continue to inch up over the next couple of months. The good news is, if you look at the category called business and professional services, that category continues to grow. every month. That's been very strong for the last 10 to 11 months. And the other one I want to mention is leisure and hospitality. That was up to 151,000. That particular sector was the worst hit in the entire time frame over the last 2 years. So we've lost thousands of jobs in that area. It's starting to come back very slowly. Now, the state of California, this is interesting. I talked to the people from Beacon's economic research yesterday, and they informed me that if you look at this, this was the December report. The January report will not be out along with February until the first week in March. The reason is they've got to go back in and evaluate the total amount of implications that took place in December from January of last year through December. So they have to go back and make some changes on the employment. So therefore, that's their primary focus. So we won't have data until March for January and February. So the interest rates, I mentioned earlier that Jerome Powell said that they're going to take aggressive steps, and it's likely that they'll stop financial easing. In other words, putting in $120 billion a month. That ends in March, and that's when you're going to start seeing things going the other way. The committee said that the inflation is running at the highest rate in 40 years, and that's got to be taken. They've got to get a handle on that immediately, or it's going to really have a negative effect on economic growth going forward, and it could sign some red flags going up late in the year. Mortgage rates, as I mentioned earlier, the cost of borrowing inched up. The average loan for mortgage, if you can believe this, is at 3.92%, and that's up from 3.56% in January. The home buying demand for mortgages basically fell 10% as interest rates continue to move up, and a lot of the buyers are now pulling back. One of the comments that came out yesterday is that when rates begin to go up, people working in the mortgage industry for refinancing, et cetera, there's going to be a lot of job losses, and that you'll start seeing that happening probably April, May timeframe. And last month they mentioned that mortgage applications to purchase dropped by 10%. So we're already seeing that happening right now. And fortunately, and by the way, the total available inventory for home sales was down 28% nationally in January from January of a year ago. So that's major impact. Now, if we take a look, the next thing I want to take a look at is manufacturing. The manufacturing index continues to be very strong. Although it dropped down by 1.5 points, we still are running at 58.7, which is very good. Again, anything over 50 is critical. Go back several months ago when we dropped into 49, which meant we were heading into a recession. So that's a very key barometer of our economy. The bad news here is on factory orders. They fell twice as much as expected in January. It's the largest month-to-month drop since April of 2020. And if we look at small business loans, we have small business confidence level here. It dropped to 64.6. It was down a few points. Unfortunately, there's a lot of concerns by small businesses on what's going to take place as we move further into 2022. Again, access to inventories, et cetera, is a real concern. The consumer confidence level, we saw a slight drop. It dropped to 113, down from 115 in January. Still very strong. So the consumer is still very strong. They're continuing to buy, making plans for things to happen as the economy opens up. So that's still pretty strong. Now we get to oil prices. So when I finished doing my report a few days ago, the West Texas Intermediate had increased to $91.07. That's up from $84.79 in January. I checked this morning before you guys got online, and it was at $105 a barrel. And we'll just have to wait and see what happens over the next few days, a couple of weeks, to see what transpires. But I'm sure that the U.S. government is looking to see what we're going to do from a contingency standpoint. Housing starts fell last month by 4.1%, really seasonally adjusted. Again, it's primarily in January. That's really this time of the year. That's typical for this time of the year. So new home sales in February, they rose 9.4%. Further evidence of still a strong market in the real estate area. Now in Southern California, the real estate prices, sales went up by about 9.4%. And Los Angeles prices were up by 13.1% to the median of around $800,000. However, sales were down by 12.4%. And in Orange County, the median was up 23%. Midpoint is $1,000,000 almost 1.2 million for a home there from Midpoint, but sales were down by 12.4%. And in San Diego, the prices rose by 4.6% to 875 for a Midpoint, and sales were down by 6.7%. So we still have a strong marketplace. We'll just have to see going forward what's going to take place. Sales of existing homes surged again, as I mentioned earlier, 6.7% in January. And basically, we still have a lot of inventory levels are still extremely low. Therefore, it's still a seller's marketplace. Productivity, which comes out quarterly. So for the fourth quarter, labor productivity inched up by 6.6%, which is very good for us. And his output was up by 9.2%. Hours worked increased by 2.4%. These are all good signs of people going back to work or people working longer hours now. So this is very positive for the economy. As far as company displacements go, only 2 companies made announcements of significance. Unilever is restructuring the business and they've laid off 1,500. And if you're familiar with Peloton, company involved in gymnasium equipment, etc., they're filing bankruptcy. They laid off 2,800 people. So what's taking place in the M&A world? Well, a lot of interesting things going on right now, which is atypical in these particular areas. So first of all, AEG Entertainment is buying a stake in LA hotels. The company plans to raise funds to help basically have planned expansion of LA Live Hospitality Complex in downtown LA. They want to increase their sales, their square footage by 150,000 square feet, of which 51,000 will be for ballrooms. So what they're doing now is they're selling off some stakes in the Ritz-Carlton and JW Marriott hotels. The New York Times is buying Wordle to expand its game business. The Daily Word is apparently a lot of people are involved with games on a daily basis with games and puzzles. So that's helping to expand their business base in that particular market area. And then we have Sony is buying a company called Bungie Incorporated, which has Destiny, Halo, and it's video games. And basically it's for $3.6 billion. And it's just a stable of different kinds of games and opportunities. This is the 3rd major gaming company to be acquired in the last month and a half. You may recall we mentioned Microsoft acquisition of Activision Blizzard. That's a $69 billion deal. So we're seeing more of that taking place. Then we have Take-Two Interactive is acquiring Zynga for $12.7 billion. Again, it's a transformative combination to expand their position in the marketplace globally. Apple is active. They've just buying an AL music startup that can generate dynamic soundtracks. So really what they want to use, if you can believe this, they're using artificial intelligence to generate personalized soundtracks and adaptive music. And then we have the airline industry. So Frontier is buying Spirit Airlines for $3 billion. This will make it the 5th largest carrier in the United States. Basically, what they're trying to do is combine to raise competition and give travelers more options to fly to some of the mid-sized cities as well as regions that are currently underserved. So this is good for the people that want to fly to different locations. And then we look at Optimum Healthcare. They're buying Change Health. Basically, what this is it's a subsidiary, and they're getting further involved in analytics. So they want to have more data, and they're allowing basically to address and reduce operating costs and administrative support in different areas to have more things that are automated. So what else is going on out there? Well, a couple of things. First of all, we talked about this a couple of years ago. The banks in general are continuing to consolidate and close branches as more people are using online banking. And what we saw basically in 2021, we saw the loss of almost 3,000 banks, and they're looking for another 3,000 or 4,000 this year to close. And again, we'll see more of that taking place. Toyota, the bad news here is that Toyota has halted production in 11 plants due to lack of parts. Now we're talking about here is in February, they're having a lot of problems getting semiconductor chips specifically for their Prius line and their luxury Lexus models. So that's having an effect in the model in that area. So production in January, they lost 47,000 vehicles were not produced, and they're just sitting idle until they can get the chips. For those of you that follow Tesla, Tesla's recalling, it's called the FSD beta software. It lets drivers, if you can imagine this, roll through a stop sign. So what they're doing is they're recalling 54,000 vehicles, the Model S, X, 3, and Y vehicles. Sid, if you own one, you'll have to get online for this. But basically what's happening is when the car comes to a stop, it automatically rolls to the stop sign. So there's some issues there that have to be resolved. Now, for those of you who like a good beer, there's a pub in England. It's closing. It's the oldest pub in Britain. It's been around since 1229 years. And it started back in 1793. It's finally closing. It's basically going bankrupt, going out of business. And there are two owners looking to take over the pub. This is long before the United States was an apple in their eye. But the thing that's interesting is it's a famous pub located in England. And then we have essentially what's happened now is Tesla co-founders seeking a way to solve the battery waste problem. All electric vehicles may be cleaner and quieter than gasoline or diesel fuel cars and trucks. However, the batteries depend on toxic metals whose mining and improper disposal and improper cause environmental degradation. So the automobile industry is going to have to work judiciously with companies that collect these old recycled batteries in every location and send them to some processing location where they can be safer for disposal. So that's going to be a major problem as we continue to buy and roll out more electric cars in our environment. So that kind of gives you a snapshot of where we are. Again, keep in mind, February was a short month. It was only 24 days, actually collecting data for 23. So we should have a lot more going forward. So what I'd like to do now, we stop the presentation being recorded, and we're going to open it up for questions and answers.
So Dennis,